Hello everyone! Today is the second review. The first one was about Bitcoin, and now we're going to look at one of the key indices of the US stock market, the Nasdaq index. At the same time, it's also an indicator of the global economy. I usually do my reviews on the Kavan Fury platform, but today I decided to make an exception and introduce you to some of my own indicators, which I wrote myself, and they are only available on the trading platform. Let's turn our attention to the chart. At first glance, the picture here is quite complicated. There are a lot of strange labels and many time frames, from 5 minutes to 1 month. The 5-minute chart is in the top left corner. The 1-month chart is in the bottom right corner. But we'll start with the top right corner. These are weekly candles. I'll explain it to you. Here are some, again, only some of my indicators. And then we'll take a look at some other time frames once we understand what we're talking about. Well, the first thing I would draw your attention to is this yellow zone. This is the so-called mathematical target for a decline. It formed last week when the index was around 25,100 points and indicated a decline to the area of 24,117 or 24,700 or about 5 to 6%. Already this week, this target has been reached. But the target for the decline is not a reversal point or a stopping point. That is, the decline may continue much like it did in May, or rather in March of this year. We reached one target, then a second target, and then went significantly lower. Second point. The indicator at the very bottom, the red line, is the overbought, oversold indicator. On this indicator, the key points are, first of all, the points where its direction changes. That is, it was moving up and then started moving down. Such points often break the trend, especially if the price is moving in the same direction as the indicator. Look, right now the price is going down and the indicator is also pointing downward. Accordingly, potential reversal points upward are in the green zone when the market or the financial instrument is extremely oversold. And the reversal point downward is the red zone, which indicates the risk of decline. Note that the risks of decline for the Nasdaq appeared as early as June of this year, or maybe even earlier. One could say they were already increasing back in May. But in June, we entered the red zone, while at that time the index was at 21,800 points. What does this mean? This means that it is highly likely we will work through this zone, and the index value will drop below these levels. The second point. Even according to this indicator, if we expand it, we can see that the direction of the local highs is downward. But if we now return to the price chart and draw the same trend line, we see that the index value was moving upward. This is a classic divergence, and its realization, this is an entry into the oversold area, and we haven't reached it yet. So for now, the decline here continues. What is the target level for the decline from a purely chart-based perspective? The target level for the decline is the 50-week moving average. But most likely, it's this area of the lows that will act as support. It's $22,800, or more accurately, 22,800 points. But again, so far, there are no indications that this decline has ended. And now that you're familiar with some of my indicators, let's switch to, for example, the monthly candles. I'll just remove all my colorings and leave the indicators. Now look, these are the monthly candles. What do we see here? We see a break in the indicator. We see a bearish engulfing pattern, which indicates that the nearest target for this decline is the base of the September candle. That's 23,480 points. We see two downside targets, one of which was reached immediately, while the second remains unrealized. That means we could reach this area, and that's very deep. That's 16,000 points to 14,500. Of course, this is not a guarantee, but you can see that the monthly candles are in a strongly overbought state. And right now, this kind of break is being observed. And there is a bearish engulfing pattern. So the downside risks are very high and the monthly candles are just starting to decline. If things continue like this and there is only a week left until the end of November, this is how the month will close. Now let's look at the daily time frame. What do we see on the daily candles? On the daily candles, we can see that we've already entered the oversold zone. But there is no reversal in the indicator. We have broken through the 100-day moving average. And I should say, this is the first time in a long while. The last time we even touched it was in May of this year. And this means that from the current levels, in principle, we could see a correction up to the 50-day moving average. It's the green one on my chart. That's around 25,000 points. Is it possible to buy here? No. Why? Because the trend is clearly downward. We're seeing only red candles, and there are no reversal patterns here at all. Moreover, since yesterday, the index price has settled below the 100-day moving average. And this means that the price movement could go much lower, to around 22,500 points, near the 200-day moving average. The fact that we've dropped so sharply is absolutely not a reason to buy. As I told you, a reason to buy would be either a divergence or an engulfing pattern. These are two basic time-tested indicators, proven over years and millions of financial instruments. Of course, there are others as well, but we're speaking in the simplest terms. We won't complicate anything. 4-hour candles. Take a look, here was a drop. There were a lot of signals here, and since they were at the bottom, they indicated a potential rise. They were green, and here was a little green target for growth. We reached it and immediately went further down. And here as well, we have neither divergence nor convergence nor any bullish engulfing patterns. That means the decline continues. Yes, of course, it could go up now, the index could move up locally, but there is absolutely no reason to buy. And so seeing this situation now, you should do nothing. If you have a short position, keep holding it. And if you are out of the market, then right now it is absolutely wrong to open either a short or a long position. It's probably too late to short now, because there is no proper entry point, and it's probably still too early to go long. Subscribe to the channel if you like this kind of analysis. We cover cryptocurrencies and the stock market. Probably a bit later we'll look at the Forex market as well. I want to do reviews on oil and update the review on gold. Leave your comments, give likes or dislikes. See you next time.